It wasn't a supply chain disruption. It wasn't a speculative frenzy on social media. It wasn't even a sudden spike in industrial demand. It was the arithmetic of debt. The pattern is unmistakable. Throughout history, when sovereign obligations reach a mathematical breaking point, the outcome is never a default in nominal terms. It is a default in real terms. The mechanism is always the same: currency debasement, and the reaction is always the same: a flight to anonymity, a flight to history, a flight to silver. Today, the global debt pile sits at roughly $318 trillion, a number so large it has lost all physical meaning. But the arithmetic is merciless. The interest on this debt is now consuming the very productivity meant to service it. The incentive is clear. Governments cannot afford positive real interest rates. They must inflate the debt away. This isn't a theory. It is a historical constant. We have seen this movie before. We know exactly how it ends. To understand why silver is the inevitable beneficiary of this cycle, we must look backward. We must examine the wreckage of empires that thought they could outrun the ledger. The Roman Empire provides the first warning. Under Nero, and accelerating into the crisis of the 3rd century, the state faced a fiscal wall. The army required payment. The bureaucracy required funding. Taxes could not be raised further without inciting rebellion. So, the incentive was to cheat. They began to clip the coins. They diluted the silver content of the denarius, from nearly pure silver to a copper coin washed in a thin silver coat. The soldier on the frontier didn't notice at first. The baker in Rome didn't notice at first. But the market always notices. Prices soared. Confidence evaporated. Those who held physical silver preserved their purchasing power. Those who held the state's promise lost everything. Just like Rome, the Spanish Empire fell into the same trap. In the 16th and 17th centuries, Spain controlled the world's money supply. Galleons laden with silver from the Americas flowed into Seville, yet the crown was perpetually bankrupt. Why? War, bureaucracy, imperial overreach. The debt grew faster than the silver arrived. To bridge the gap, the crown issued copper vellon currency. They forced the population to trade their silver for base metal. The premium on silver skyrocketed. The price of bread and copper currency exploded. A peasant in Castile saw his wages stagnate while the cost of living doubled, then tripled. The silver didn't disappear. It went into hiding. It moved into strong hands. It exited the system. Just like Spain, Weimar Germany proves the speed at which this unraveling occurs. In 1914, the mark was gold-backed and stable. By 1923, it was confetti. The war debt was unpayable. The reparations were crushing. The industrial heartland was occupied. The government had one tool left, the printing press. They printed to pay the workers. They printed to pay the debt. The velocity of money accelerated until the currency died. But notice what happened to value. A factory, a block of land, or a silver service set didn't lose value. They were priced in billions of marks. The middle class, holding paper savings, was wiped out. The speculator, holding hard assets, became the new elite. The pattern repeats in 7 distinct stages. Stage 1 is sound money, where the currency is hard and trust is high. Stage 2 is expansion, where the state begins to spend beyond its means for war or welfare. Stage 3 is debt overhang, where the accumulated obligations exceed the tax base's ability to pay. Stage 4 is debasement, the critical turning point where the state chooses inflation over default. Stage 5 is inflation, initially dismissed as transitory, then accepted as structural. Stage 6 is the flight to assets, where capital abandons the currency for land, gold, and silver. Stage 7 is the reset, where the currency fails and a new standard is established. Just like the historical precedents of Rome, Spain, and Germany, we are currently moving through these stages with alarming precision. Current data suggests we are firmly entrenched between Stage 4 and Stage 5. The debt-to-GDP ratios of major economies have surpassed levels seen during the Second World War. The interest payments on U.S. federal debt alone now rival the defense budget. Under these constraints, the rational move for central planners is not austerity, which is political suicide, but financial repression. This means keeping interest rates below the rate of inflation, effectively transferring wealth from savers to the state. This environment is the rocket fuel for silver, which remains one of the few assets still priced roughly 50% below its all-time high from decades ago. Despite the money supply expanding exponentially, there's a common counterargument to this thesis. Many economists argue that deflation, not inflation, is the greater threat. They point to demographic decline and technological innovation as forces that will drag prices down, crushing commodities like silver in the process. This view relies on the assumption that central banks will allow a deflationary collapse to clear the system. However, history and incentive structures suggest otherwise. In a fiat system with $318 trillion of debt, deflation is the systemic equivalent of death. It increases the real value of debt, triggering immediate mass insolvency for governments and corporations alike. The incentive is to print at all costs. The risk of hyperinflation is preferable to the certainty of deflationary default in the eyes of the sovereign. This leads us to three potential endgames. The first is controlled decline. In this scenario, central banks manage to keep inflation consistently higher than interest rates for a decade. Bondholders are slowly bled dry, losing 4–6% of their purchasing power annually. Silver acts as a mirror, reflecting the true depreciation of the currency, steadily climbing as the paper dissolves. We saw this during the British Empire's long sterling decline from 1914 to the 1970s, where the pound lost its reserve status not in a single day, but over decades of erosion. The second endgame is chaotic collapse. This occurs when the bond market revolts. Investors refuse to hold long-term government debt at negative real yields. Yields spike, forcing the central bank to monetize the entire debt stack. Confidence breaks. The currency enters a death spiral similar to Weimar Germany in 1923 or Zimbabwe in the 2000s. In this scenario, silver does not just appreciate, it becomes unavailable. It vanishes from the open market, trading only in private circles for other real assets. The third endgame is a reset and restructure. This is the historical norm following a currency failure. Governments introduce a new currency, often pegged to a basket of commodities or hard assets, to restore confidence. We saw this with the introduction of the Rentenmark in Germany, which was indexed to land and industrial goods to stop the hyperinflation. In a reset scenario, silver and gold are often revalued overnight to backstop the new system, locking in a significantly higher price floor relative to the old currency. The only variable is timing and pain. If you found value in this analysis, subscribe for more briefings on macro historical cycles.